There's a peculiar comfort traders find in lines, those smooth, sloping curves crossing the chart, whispering signals of when to buy and when to sell. The moving average, it looks so simple, almost too simple, yet it's one of the few tools that has survived every generation of traders, from the ticker tape days to today's glowing screens. And like everything else in this game, its true value isn't in what it shows, but in how you interpret it and whether you have the discipline to obey it. Let's speak plainly. There is no magic formula that guarantees success in the market. Every tool, whether it's a moving average, a price pattern, or a volume signal, is only as effective as the trader behind it. What separates the winning trader from the losing crowd isn't the strategy. It's the patience, the restraint, and the understanding that the market doesn't care about your opinion. It cares only about movement, and your job is to align with that movement, not fight it. Now, let's talk about moving averages. The moving average is nothing more than the reflection of price over time, a smoothed-out mirror showing the trend's direction. In my trading days, we didn't have computers drawing these lines for us. We calculated them by hand, line by line, closing price after closing price. It was tedious, but that effort forced you to understand the rhythm of price, not just the numbers. You felt the heartbeat of the market. Today, most traders have lost that feel. They stare at lines without understanding what those lines truly mean. A short-term moving average tells you what traders are doing now. A long-term moving average tells you what the market has been doing over time. When the two cross, something significant is often happening beneath the surface, a shift in behavior, a turn in sentiment, a signal that the tide may be changing. But don't let those crosses fool you into thinking it's automatic profit. The market loves to deceive. The crowd jumps in on the first cross, and the professionals wait for the crowd to exhaust itself. Let me share something that cost me more than a few fortunes to learn. Confirmation matters more than prediction. A moving average crossover isn't a call to action, it's a warning light. It tells you to prepare, not to rush. Watch the volume. Watch how price reacts to that line. The real move begins when the amateurs give up, not when they get excited. Most traders use moving averages like a crutch. They trade every signal blindly, thinking the tool will save them from themselves. But the truth is, no line on a chart can protect you from your own impatience. A moving average works when you learn to use it as part of a system, not a shortcut. It's the trader's job to define the context, what time frame you're trading, how much risk you can afford, what confirmation you require before you enter. Let's take the classic 20-period and 50-period moving averages, for example. On the 5-minute chart, this can help you identify short-term momentum shifts. When the 20 crosses above the 50, it suggests buying pressure. When it crosses below, it hints at selling dominance. But here's where most traders get destroyed. They jump in the moment they see that cross, without checking the bigger picture. The higher time frame trend might still be bearish, and they're buying into a trap. The professionals wait for alignment when the short term and the long term both point the same way. That's how money is made, not from guessing, but from aligning probabilities. The market pays those who wait for multiple forces to agree, not those who chase every flicker of price. Another principle I learned early: the market rewards patience and punishes urgency. Moving averages teach this lesson perfectly. When price pulls back to the average, most traders panic. They think the move is over. But if the trend is strong, that average becomes a springboard. Professionals buy near it, while amateurs sell. They call it support and resistance today, but it's nothing new. It's just human nature displayed on a chart, fear and greed cycling endlessly. The trick is not to trade every touch or crossover, but to understand the psychology behind it. When price moves too far above the moving average, excitement reaches its peak. Buyers are exhausted. When it dips too far below, fear dominates. Sellers are spent. That's when opportunity hides in plain sight. But discipline is the difference between seeing opportunity and seizing it. Too many traders talk about strategy but ignore money management. You can be right on direction and still lose if your position size is wrong. You can be wrong on direction and still survive if your risk is controlled. The moving average doesn't protect your capital, your stop loss does. Your mind does. And your willingness to step aside when the market proves you wrong does. When I lost millions, it wasn't because I didn't know how to trade. It was because I broke my own rules. I let excitement replace logic. I let overconfidence replace observation. Every trader faces this battle. The moving average can help you navigate it not because it's perfect, but because it teaches consistency. It smooths the chaos, showing you the average of human emotion over time. You see, markets are not moved by numbers. They are moved by people, and people haven't changed in 100 years. The same fear that drove traders out of the market in 1907 drives them out today. The same greed that made them buy the top then makes them buy the top now. Tools change, screens change, but the game remains the same. So here's how to use the moving average the right way. Start with context. Identify the trend on a larger time frame, say the 4-hour or daily chart. If the 50-period average is rising, you're in an uptrend. Now move to your smaller time frame, perhaps the 15-minute or 5-minute. Wait for price to pull back toward the moving average and confirm direction. Don't chase. Let the market come to you. Look for volume to contract during the pullback and expand as price moves away. That's your cue. That's where the professionals act. Don't trade every cross. Trade when the market confirms the story. And remember, no setup works perfectly every time. What makes it perfect is your ability to execute it with discipline every time, without emotion. If the trade moves against you, get out quickly. Small losses are tuition fees. The market charges them to everyone. But large losses are the result of ego, not strategy. If the trade moves in your favor, don't rush to take profit. Let the moving average guide you. As long as price holds above it, let the trend continue. You'll never capture the entire move, but you can capture enough of it to make your effort worthwhile. Trading success doesn't come from knowing more indicators. It comes from mastering a few principles deeply. The moving average can be one of those principles, a companion in chaos, a filter against impulse. But you must remember, it doesn't predict the future. It reveals the past. Your job is to read that past clearly enough to act with confidence in the present. Many traders lose because they're searching for certainty. They want a strategy that always works. There is no such thing. What exists is consistency, a strategy that works often enough when applied with discipline. That's the only secret worth keeping. Markets have always been battles between the informed and the impulsive. The moving average helps you stay informed, not because it gives you inside information, but because it forces you to see trends as they are, not as you wish them to be. It's a mirror, not a map. Every trader eventually realizes this truth. You're not trading the market. You're trading your own reactions to it. The moving average simply helps you measure those reactions. It tells you when to act and, more importantly, when to wait. And waiting, that's the hardest trade of all. If you've been jumping from one strategy to another, always chasing the next secret method, I'll tell you now, stop. Master one. The moving average, when understood deeply, can be enough to make a career, but it demands patience, humility, and consistency. Study it. Watch how price behaves around it in every market condition. Learn to feel when the market respects it and when it ignores it. That sensitivity, not the line itself, is what separates amateurs from professionals. So, the next time you look at your chart, ask yourself this: are you reacting to the market, or are you reading it? Are you chasing signals, or are you waiting for confirmation? Because the difference between those two will determine whether you join the ranks of traders who last or the crowd that fades away. If you found value in this reflection, make sure you subscribe for more insights. I want you to share in the comments how you use moving averages, what challenges you face, what lessons you've learned the hard way. Every trader's journey is different, but the principles that govern success are the same. Trading isn't about perfection. It's about progress, the steady refinement of judgment, patience, and courage. And if you can learn to let a simple line on a chart teach you discipline, then you've already won half the battle. The market rewards mastery of self before mastery of strategy. And the moving average, in its simplicity, is one of the finest teachers of that truth.